Bismillahirrahmanirrahim. In the previous class, we discussed about horizontal analysis, vertical analysis, common size analysis, and index analysis. Today, we are going to start trend analysis. Now, trend analysis basically it finds out the direction of the results in all the techniques discussed above. Whatever techniques we discussed in the previous class, horizontal, vertical, trend, and index analysis, just trend analysis just shows the direction of the results, whether it is going upward, whether it is going downward. Like see, this thing, it is showing an upward direction, upward trend. So trend analysis just shows the direction of the results. It is used while performing the other techniques of FSA. And we are using it when we are using the techniques of financial statement analysis. Trend analysis is used while performing the techniques of financial statement analysis. We just see that the result is positive or negative. It will just tell us whether the result is positive or result is negative, nothing else. Whether there is a weakness or strength. It will tell us about the strength and weaknesses. Trend analysis, it will just show positive or negative results or weaknesses or strengths in a trend. Here is an example, trend percentages example. Wheeler Incorporation provides you with the following operating data and asks that you prepare a trend analysis. From this data, we will prepare a trend analysis. Now see, 1995, 1996, 1997, 1998, and 1999. 5 years data from 1995 to 1999. Revenues, expenses, and net income. Only the data about revenues, expenses, and net income it is given. In 1995, revenues are 1,820 and expenses are 1,701. So the difference between these two, that is net income, is 119. 1996, 1991 and 1803. So result is 188. That is the net income. 242, then the next is 278, then the next is 372. Now we will find the trend analysis. Now here the data is given. We took the data of 2 years and we want to see whether the result is positive or the result is negative. So see here, our revenues are 1,820 and here our data is our net revenues are 1,991. So from this we will deduct this 1991 minus 1820. So we got positive 171. So this is showing us that there is an increase in the revenues. Now we will convert it to percentage. 171 divided by the base year result. See, the difference is 171 and base year is 1820. So 171 divided by 1820 multiplied by 100. So we are getting 171 divided by 1820. So we are getting 9% rounded data. means it is telling us that there is a 9% increase. So the base year data is 100% and there is a 9% increase, so it becomes 109%. Same is the case here, 116%, 123, 132. So you can find all the data in percentages. Just take what from current year 1996, we will deduct the base year 1820 and then divide the data by the base year. Base year revenue, it was 1820. So we got 9% rounded data. So same is the case. So the base year data is 100%. So this will become 109% because there is a 9% increase. So 100 plus 9, it becomes 109. Similarly, the next year data. Similarly, this year's data, this minus this. So you will check whether there is increase or decrease. This minus this divided by this. So just like I told you in the previous classes, current year minus base year divided by base year and multiplied by 100. So we will get a percentage. So this is basically the trend analysis. Next year data will be calculated like this. See, current year minus base year, 2112 minus 1820, 2112 minus current year minus base year 1820 and divided by base year 1820 and multiplied by 100 for percentage. So see, 16% is the change. So see here, 16% change. So from 100 it becomes 116. Now next year 2244 is current year, this is base year. 2244 minus base year is 1820 divided by base year 1820 and multiplied by 100. So it becomes 23.50. So look at this, 123. 23% is the increase. So it becomes 123%. So I'm using the same formula. Current year minus base year divided by base year multiplied by 100. Current year minus base year divided by base year and multiplied by 100. Similarly, for this, again, current year minus base year divided by base year. Similarly, for expenses, 1996, so this current year will become 100%. Now current year minus base year, 1830, sorry, 1803 minus current year minus base year is 1701, 0 1 divided by base year is 1701. 1701 multiplied by 100. So we got 5% change, or you can say 6%. So see, this is 6%. It was 100%. There is 6% increase, so it becomes 106. Similarly, for next year, this minus this 1870, 1870 minus 1701 divided by base year 1701 and multiplied by 100. So there is a 9.93. So 9% increase, so you can say 10%. So see, there is a 10% increase. Similarly, you will calculate it for net income. And on the base of this, now we will make a trend line. See, this is revenue, this is expense. Sales, this color, expenses, this color. So see, first year it is 100% both revenues and expenses. Next year there is an increase of 9% in sales. I don't know what was this. In 9% increase in revenues, sales, and 6% increase in expenses. So see, this is 9, this is the height of this, it is 9, and the height of this is 6. Similarly for this year, similarly you will make for this year, similarly for this year. Then you will draw a line which will pass through this point, like this. This will be the line. It will meet it here. Similarly for expenses, see, from here, this line. So these will be the trend lines for sales and trend lines for expenses. And this is all about the trend analysis. That trend analysis will just tell us about increase or decrease, positive change or negative change, strength or weaknesses. So now our revenues are increasing, so it is showing a strength. So this is all about this trend analysis. We are starting the next chapter. The next chapter name, it is financial ratio analysis. Our focus in this chapter will be ratio analysis. There are some terminologies, but we will discuss these terminologies later on. EBIT, EBITDA, you know about this. Contribution margin, gross profit, EBITDA, EBIT, net profit. We will discuss it later on, not now. Now come to financial statement analysis. In financial statement analysis, what is the purpose? Why we are doing financial statement analysis? To make certain decisions. Which type of decisions? To determine relative strengths and weaknesses of a company. Why we are doing financial statement analysis? For the strength, for getting information about the strengths and weaknesses of a company. What are the strengths of a company? What are the weaknesses of a company? You know about SWOT analysis. So this is a tool used for SWOT analysis. to evaluate past performance and map future plans. We want to evaluate the past performance. You will evaluate the past performance of the company, and on the basis of past performance, we will map future plans. That what will be our future plans. Keep in mind whenever you are making budget, so making budget is on the base of past performance. You will see the past, and on the base of that past you will make the future budgets, future plans. To estimate future cash flows and riskiness of those cash flows. To making an estimate of the future cash flows, that what will be the future cash flows and what will be the riskiness of those cash flows. For making what? Investment and lending decision. Why you need estimate of cash flow? Because you want to invest some money or you want to lend some money. Lending means giving loans. Investment means when you have excess money, you're going to invest it so that you can earn a return on this. Keep an eye on the performance of a company to safeguard investment and to take corrective actions. Why we are doing financial statement analysis? To keep an eye on the performance of company. We want to keep an eye on the performance of company and to safeguard investment, to secure your investment or to secure the investment of the shareholders, and to take corrective actions. And if we are not going in the right direction, so what will be the corrective actions? To decide whether to keep doing business with the company. On the basis of ratio analysis, we are making analysis whether to continue business with the same company. Investors, I'm talking about investors. So it is giving an idea to investors whether to keep doing business with the company or leave the company. So these are the reasons of financial statement analysis. Now, there are two types of financial statement analysis. One is cross-sectional financial statement studies, and one is time series financial statement studies. Now, what is cross-sectional financial statement studies? A level is needed by which to judge a company's performance. This is a method used for measuring a company's performance. This level can be obtained by comparing companies within the same industry with other companies. Now, in cross-sectional analysis, what are we doing? We are comparing the performance of our company with the performance of other companies in the same industry. Just like if you people remind, I told you that apples will be compared with apples. Apples will be compared with apples. So we are measuring the performance of a company, of our company, with similar companies in the industry. Suppose we are working in cement industry, so our performance will be measured with other cement companies in the same industry. We can't compare our performance of the cement company with a university, with a bank. No. So apples will be compared with apples. Apples cannot be compared with mangoes. So this is what we call it cross-sectional analysis. This is known as cross-sectional study, comparing your performance with other similar companies in the industry, or with your competitors. Simply you can say with your competitors. Time series financial studies. Now time series, from the name it is clear, time series with respect to time, to compare the accounts of what one company with its own previous years. Time series, comparing your performance with your own performance in the past, like 2016, 2017, 2018, like this. And this is suppose your current performance, 2019. So comparing the 2019 performance with 18, with 17, with 16. Comparing your present performance with your past performance. This is called time series financial statement analysis. Possible to see if a company is improving in certain areas or not. Here, our aim is to check whether there is an improvement in some areas of the company or not. This is known as time series study. We call it what? We call it time series studies. External comparison, so same thing. This involves comparing the ratios of one firm with those of similar firms. So external comparison and cross-sectional financial statement studies, same thing, are to compare the ratios of one firm with those of similar firms or with industry average, or comparing your company with the whole industry average. Similarly, it is important as one should compare apples to apples, to compare the ratio of Salam and Kardan. Here's an example. University will be compared with university. University cannot be compared with a cement company. I think for today it is enough. Inshallah, in the next class, then we will talk about other things. We will start ratio analysis in detail. Assalamu alaikum.